Hi class. In this video we're going to review a problem from chapter 5. So in this particular video we're going to look at a problem that's very similar to P5-18 from your homework. So I've created a template and given some information here that we're going to walk through. So the information for our company says that Haas Company manufactures and sells one product. We've got 3 years of data right here related to operations. So it looks like we've got some variable costs and some fixed costs, and these are all either per unit or per year. And then down at the bottom it says during its first year of operations we have produced 60,000 units and sold 60,000, and we have some similar data for year 2 and year 3. And then finally it says the selling price of the company's product is $57 per unit. So that's all the information that we're given. The first thing we have to do is compute the company's break-even point in units sold. Let's start that over. So I have created sort of a template here to walk through the calculations. So before we can actually do the break-even point in units, we're going to have to calculate our contribution margin. So to do that, we need our selling price, and that was given in the instructions right here. The selling price of the company's product is $57. So let's put that in there. The next thing we need is our variable cost per unit. So in our information we have this chart that tells us variable cost per unit. We have 4 items here. So direct materials, direct labor, variable manufacturing overhead, and variable selling and administrative. So each of those categories of costs combine to make our total variable cost per unit. So if we add 25, 17, 8, and $3, that's going to tell us the total variable cost per unit. So that added up is actually $53. So after we know those two pieces of information, we can calculate our contribution margin. And the contribution margin is just the selling price per unit less the variable cost per unit. So we have $4 that is our contribution margin. Now basically what that's telling us that is if we sell a product for $57, we can cover all of our variable costs that it took to make that unit. Plus we have $4 left over that we can put towards our fixed cost. So we're looking at how much do we have left to contribute towards the cost, or to contribute or to put towards the cost of our fixed cost for the product. So our contribution margin we've calculated at $4. The next thing we can do is actually do the break-even unit sales calculation. So I've got the actual equation here. Break-even unit sales equals fixed expenses divided by the unit contribution margin. In other words, up here we calculated how much we would have left over after each sale to put towards our fixed cost. So every time we sell a unit, we're covering 100% of our variable cost, and we're covering $4 of our fixed cost. So down here, if we take our fixed cost and divide it by the $4, we'll know how many we need to break even, because with each unit we already know that we're covering our variable cost and we're covering a portion of fixed. So that's all this calculation is doing. So to do the actual calculation, we're going to take our fixed expenses, and those are given up here in the instructions. So it says fixed cost per year, we have an amount for fixed manufacturing overhead and fixed selling and administrative expenses. So that's the $150 and the $90,000. So we're going to add both of those together to get our total fixed cost. So $150,000 plus $90,000 is $240,000. And we're going to divide that $240,000 by the fixed cost that we have to contribute toward that total cost per unit. And that tells us that it's going to take us 60,000 units sold to actually break even. In other words, we're not going to have a profit, we're not going to have a loss, we're just going to have a zero net profit, so break even. So this is actually the answer to requirement 1. Requirement 2 says assume the company uses variable costing, and there's actually 2 parts to requirement 2. 2A says compute the unit product cost, and we have for 3 different years we're supposed to do that. So let's see. I've got a chart here that we're going to use, and we're doing variable costing. So when we do variable costing, we're only looking at variable cost. So we're not going to consider any fixed costs in the calculations for requirement 2. Now when we go on to the next set of calculations in requirement 3, we're going to look at absorption costing, and absorption costing actually does consider fixed costs. So generally, absorption costing is a better metric to use because you're looking at, well, how do I cover all of my costs? With variable costing, you're not giving any consideration to your fixed costs. So that is an issue with using the variable costing. All right, so to do our calculation, we're looking at what is our variable cost per unit, product cost. So we were going to consider only variable costs, direct materials, direct labor, and variable manufacturing overhead. So we have got, let's see, direct materials is $25 per unit, direct labor is $17 per unit, and variable manufacturing overhead is $8 per unit. So I'm going to go down here and plug those in. Let's see, 25, 17, and 8. So that is all given in our instructions. So we add those together. That tells us what our variable cost is per unit. So we're going to do that for all 3 years. So up here, well, actually, I don't think it changed. No, we have data. It says it's the same for each year. So the amounts for variable costing are the same for all 3 years. Let's see if this will let me copy it over. Yay. So that's all there is to Part 2A because every year has the same variable costs as the other years. Part 2B says we are to do a variable costing income statement for 3 years. So I've kind of made a little format we can use. So we are actually going to have to do some calculations in this. So let's see, our sales, we know that we're selling our product for $57 a unit, and they told us how many we sold up here. So it says we sold 60,000 units the first year. I believe. Let's see. Well, if I could operate a calculator, would be helpful. Okay, so 60,000 units times $57 a unit tells us our sales for year 1, and that is $3,420,000. We're going to do the same thing for year 2. We still have a unit we're selling for $57. Says in second year of operations it produced 75,000 units and sold 50,000. So that gives us, if we multiply that together, excuse me, 2,850,000. And we're going to do the same thing for year 3. We sold 65,000 units. And that was at $57 each. So we've got $3,705,000. All right. So we have then to calculate our variable cost of goods sold or variable selling and administrative. So let's see. We've got variable cost of goods sold and variable selling and administrative makes up the total variable manufacturing cost, which is up here in the chart. So we're going to split these or divide these by our cost of goods sold, which is the first 3 items, direct material, direct labor, variable manufacturing overhead. And that's actually, let's see, where did we calculate that? We calculated here in Part 2A for our variable costing unit product cost. So those are $50 per unit that it cost us in cost of goods sold. Selling and administrative is $3 per unit. So let's see. In the first year of operations, we sold 60,000 units. So right now I'm calculating the variable cost of goods sold. So 60,000 units that we sold, and they cost us $50 in variable cost each. So 60,000 times $50 each is $3 million. And let's see, I can't remember my numbers. Year 2 was 50,000 and year 3 was 65,000. So in year 2, we would take the $50 times the 50,000 that we sold would be 2,500,000. And in year 3, we would take the $50 times 65,000 is $3,250,000. So that's our variable cost of goods sold. So we're just taking the number of units we sold times the variable cost in each case, which is $50, and that's actually right here that we've totaled up. We'll do the same thing in our variable selling and administrative, except for we only had $3 each in selling and administrative cost, and that's from up here in our given information right there. So we're going to use the same number of units sold, but just times $3. So the first year we had 60,000 times $3. Is this 180,000? I think it was 50,000. Yeah, 50,000 units the second year, so that's 150,000 if you multiply that by $3. And then we've got 65,000 units the third year times $3 is $195,000. So then we can add together our variable expenses, which is the variable cost of goods sold and the variable selling and administrative, and we come up with our total variable expenses, and then we can calculate our contribution margin. So that is simply your sales less your total variable expenses. So that gives us our contribution margin, and I'm just going to copy that over. And then we're going to move on to our fixed expenses. And I believe that was given up here. Yeah, so we have fixed costs per year. So we don't even have to calculate anything with these. We're just going to plug these numbers in. We've got fixed manufacturing overhead, fixed selling and administrative expenses. We've got 150,000 and 90,000. So we're just going to plug those in down here. 150,000 here and 90,000 in the next box. And they didn't fluctuate by year. They're fixed. They're all the same. Oops, I'm missing a 0 on my 150. There we go. Let's try that again. All right, so 150,000 fixed manufacturing overhead, 90,000 in selling and administrative. So then we can add those two things together and get our total fixed cost, which are 240,000 per year. So the next thing we're going to do is calculate our net operating income or loss. So to do that, we're going to look at our contribution margin. We're going to subtract out our total fixed expenses. So in year 1, we were actually at break even, which makes sense because if you remember, where were we? Back up here in requirement 1, we said we needed to sell 60,000 units to break even. Well, guess what? Here it says we sold 60,000 units. So we actually were just at break even in year 1. Year 2, we're going to take the contribution margin less our fixed expenses. And the same thing in year 3. So in year 2, we actually lost $40,000, and finally by year 3, we're getting some momentum, and we actually made $20,000. So we're going to move on to requirement 3. It says assume the company uses absorption costing, and we're to calculate the first thing we're going to do is compute the unit product cost for years 1, 2, and 3. So this is almost like what we did with the variable unit product cost, except for this time we're going to consider our fixed manufacturing overhead. So if you'll notice, I've added a line right here that is fixed manufacturing overhead. The rest of it is the same, direct material, direct labor, and variable manufacturing overhead. So we're going to plug in those amounts. We've got $25 in direct material, $17 in direct labor, $8 in overhead, and that actually is exactly the same as what we had up here in Part 2A, and that all came from the chart up here towards the top. And none of that changed over the 3-year period of time, so I'm just going to copy that over because that's all the same. Now we have our fixed manufacturing overhead, and we actually have to calculate that. So let's see, we had fixed manufacturing overhead, looks like, of $150,000 every year, and that you can get that from the chart above, but actually it comes from over here. Fixed manufacturing overhead. So we're only considering fixed manufacturing overhead. Fixed selling and administrative expenses we don't include that in the calculations when we're using absorption costing, at least at this point, because we're calculating the cost of our product, and selling and administrative expenses is considered a period cost. So we've got to work with this $150,000 fixed manufacturing overhead. So let's find my place back down here. So to calculate, and we're doing this by unit, so to calculate the per unit amount, we're going to take $150,000 and we're going to divide that by the number of units we sold. So in year one, we sold 60,000 units. Whoops. Let me fix these so we've got some decimals so we can look at that. All right, so we've got $2.50 in fixed manufacturing overhead per unit. In year two, we're going to again work with $150,000 in fixed overhead. But in year two, we sold 75,000 units, I believe. Let me make sure I got that right. Oh, I'm sorry, we produced 75,000 units. And we produced 40,000 in year three, so we're going to use that amount in year three. So we're going to take the 150,000 divided by 40,000 units produced. Oops, got a mistake in my formula. There we go. I'm missing a zero. All right, that looks better. $3.75. So in our fixed manufacturing overhead, we're taking the total fixed overhead of $150,000, and that's the same for year one, year two, and year three. And in each year, we're dividing that by the number of products that were produced or manufactured. So in year one, it was 60,000. Year two, it was 75,000. Year three, it was 40,000. That gives us a fixed manufacturing cost per unit. So if we add all of those, will actually give us an absorption costing unit product cost. So we got $52.50 that actually cost us in total with variable and fixed overhead to produce our item in year one, $52 even in year two, and $53.75 in year three. So the next thing we're going to do is to calculate or to prepare our income statement. And it looks fairly short, which is probably good news for you. So to do that, we're going to use this chart. We're going to take our sales less our cost of goods sold less our selling and administrative expenses. So most everything is simplified, lumped together in this chart. So in our sales, we could calculate our sales again, but we already did that once when we were doing the variable cost. And the sales amount's not going to change because we didn't change our price or anything. So we're still going to use the $57 price times the number of units sold, and under both methods we sold the same amount. So these amounts are actually the same for either method. So I'm just going to cheat, copy and paste those down here. The next thing we need to calculate is our cost of goods sold. So let's see, the first year it says we manufactured 60,000 units and we sold 60,000 units. So it was year one, new company. So to calculate our cost of goods sold for that first year, because everything we manufactured we sold, so we're going to take the 60,000 units that we manufactured and sold times $52.50, which is how much it costs us to do one unit or each unit. So that gives us $3,150,000. We can find our gross margin, which is our sales less our cost of goods sold. Our selling and administrative expenses Let's see, I believe they were $3 a piece. Let's see. Oh, $90,000 was the total. So let's see. I have lost my place here. All right, let's go back up here. Our cost of goods sold, excuse me. The next year it says we had 50,000 units. We're going all the way up here to our instructions. We sold 50,000 units. And of those 50,000 units, all of them were manufactured in year 2 because we already sold everything we manufactured in year 1. And that matters because, sorry for all the scrolling, because we have a different product cost depending on what year the item was manufactured. So here's our absorption cost that we used for our cost of goods sold for year 1. In year 2, we sold 50,000 units, and they were all manufactured in year 2. So everything manufactured in year 2 cost us $52 a unit. So we're going to take the 50,000 units and multiply that by $52. Gives us $2,600,000. And then we can calculate our gross margin by taking our sales less our cost of goods sold. And that is our gross margin. So then year 3, it says, let's see, we produced 40,000 units and sold 65,000 units. So we actually sold more units in year 3 than we produced in year 3, and that matters because we have a different cost per unit depending on what year the units were manufactured. So we can actually, where we are actually selling some stuff that we created or manufactured in year 2. So if it says we sold 40,000, or we sold 65,000 but we only made 40,000, the other 25,000 has to come from year 2 inventory. So this one's a little more complicated. So I'm going to type in a formula here. So in year 3, we're selling 25,000 units out of our year 2 inventory, which was $52 a unit. So that's that formula. And we're going to add to that the other 40,000 that we sold from year 3 inventory. That was $53.75 each. So here's my formula if you can see that. 25,000 units at $52 each and 40,000 units at $53.75. So we have to add those two things together. Gives us $3,450,000. So we're going to take my sales less my cost of goods sold. Gives us our gross margin. All right. So let me go back to our selling and administrative expenses. We're looking at our variable selling and administrative expenses, which is $3 each. And let's see. And we also have some other, we have 90,000 in fixed selling and administrative expenses. So we're going to include that $90,000 in this calculation. If I could type right, let's see. So all the way down here, let me find it. We have two categories, the fixed and the variable. So we're going to take the $90,000 in fixed, selling and administrative expenses, plus we have $3 for each item we produced in variable. So that's $3 times 60,000 units. I left out my equals. All right, that's $270,000. So in each of these cases, we've got the $90,000 in fixed. And let's see. So we're going to add that. We're going to take the $3 in variable, and we are going to use the number of units sold in year 2, which was 50,000. So that's $3 times 50,000. So there's our formula for that. 90,000 plus 3 times 50,000 is 240. Same thing over here. We're going to take the 90,000 and add to that 3 times, I can't remember, 65,000. That was the units sold. 3 times 65,000. I got one too many zeros. All right, so there's my formula for that. 90,000 plus 3 times $65,000 is $285,000 in selling and administrative. So we had a gross margin. We had additional selling and administrative expenses. So we're going to subtract those out. So your gross margin less your selling and administrative gives you your net operating income or loss. This one, we're still at break even, but you'll notice in years 2 and year 3 our numbers look a little bit different. So in year 2 we actually had a net operating income of $10,000 and net operating loss in year 3 of $30,000. In what's this, 2B, when we used the variable costing method, we had a net loss in year 2 and a net gain or net income in year 3. So a little bit different. That's because we're shifting around our fixed costs and how we calculate those. So you do come out with different amounts when you're using variable as opposed to absorption. So that's just something to notice. So let's see, just kind of to recap. In number 1, we had 60,000 units. That was our break even. In 2A, we calculated our variable costing unit per product. So that's right there. And 2B, we prepared an income statement. So this is our bottom line, but actually all of this is our calculations. And then in year 3, we did the same thing, except for we used absorption costing, which included those fixed manufacturing costs right there. And then in 3B, we did our income statement once again, but we used those absorption costing numbers to do that. So I think the hard part is, well, for 1, scrolling up and down, and 2, remembering where those selling and administrative expenses go, and remembering what to multiply by, whether it's the number of units that was sold or the number of units that were produced. So that is a little bit tricky, but hopefully this example will give you something to go by as you do your homework. And as always, if you need help, never hesitate.